Sean, and thank you. Thank you for inviting me, and thank you also for the kind introduction. And good morning, ladies and gentlemen. And that photograph, by the way, was taken a good few years ago. I always insist that that photograph is used because it's only about 10 years old. So this morning I'm going to talk about mainly about the markets. I'm not an advisor. Sean and his team are the advisors. I'm just a fund manager, and I've been managing money for Zurich for about 27 years. So going to talk a little bit about the markets, a little bit of economic, a little bit of investment history, and then what we think might happen to markets in the future. I'm going to talk about a couple of our funds, not really as a marketing exercise, but just to give you an example of the type of funds that are popular in the marketplace at the moment. About 2 weeks' time, on the 9th of March, will be the 8th anniversary of the current bull market in equities. So I heard mentioned earlier on, people don't like equities, and actually people don't like equities very much, and haven't liked equities all the way through the bull market we've had for 8 years. A very long bull market. It's the second longest bull market in history. There have been 26 bull markets in equities in the history of markets. We're currently in the second longest one. The longest one was 12.5 years. I don't think we'll go back to, the current one will last that long. But certainly equities have been very strong, and also government bonds, second main asset class, have been also very strong for quite some time. In fact, bonds have been in the bull market for 35 years. Incredible that bond markets have done so well. The yield has fallen and fallen and fallen over the years, mainly due to inflation falling. From the big oil shocks in the 1970s, and there's one or two people in the room here who might remember the 1970s as regards the markets, and they might remember there were huge oil shocks in 1973 and 1979, and inflation was very high, and of course since then inflation has fallen dramatically, and bonds have done very well until recently. Bonds are now in decline, and I'll talk about that later on. So equities have been doing well. Bonds have been doing well, property's been up and down. I'm going to talk about the main asset classes because we believe at Zurich that multi-asset funds are the best way for investors to invest their money. To put all your money into one asset class is not a good idea. You should diversify your money, and all the growth in our funds in the last decade, almost all the growth in our assets under management has come from multi-asset funds. The old-fashioned managed funds, the newer-fashioned risk-targeted multi-asset funds. That's the growth area, and I think that the most important thing is to choose a fund manager who's active rather than passive with their asset allocation. A manager who's prepared to move in and out of different assets to take advantage of the underlying conditions. At Zurich at the moment, we're significantly overweight, as we call it, in equities. We're significantly underweight in government bonds. And the main reason for that is that equities are much better value than government bonds. Equities yield 6.5% as regards the earnings yield. That's the inverse of the price earnings multiple. 3.5% for dividend yield, so equities yield quite a lot. Bonds are yielding close to zero in the Eurozone. Cash, the worst long-term investment you could possibly have, is yielding currently zero. Properties somewhere in the middle. So equities give the best long-term returns. They offer the best yield at the moment, and that is why we are overweight equities. We went overweight equities back in the summer of last year. I mean, we've been in and out of equities all the time. We've been overweight them for most of the last 8 years, but we went significantly back into markets in early summer, late autumn of last year, and that's paid huge dividends for our performance over that period. It's coincided with the US general election. It wasn't the reason why we went overweight equities. We went overweight equities because they're much better value than other asset classes. But the US presidential election has helped us. Now, we can leave aside, we say very, very neutral on US politics here. But what I would say, and why the reasons have liked the US election result, is because of Donald Trump's plans to cut corporation tax rates. It's quite simple as far as we're concerned. For every 1% cut in corporation tax rates, that improves US corporate profits by approximately 1%. Corporation tax rates are roughly around 35% at the moment. They're probably going to come down to 25 or 20%, and that's going to give a boost of 10 or 15% permanently to US corporate profits. And that is why the markets are up 10% or more since the US general election result. Okay, so that's helped our cause, but it wasn't the reason why we went into the markets. Okay, I've got some slides here, and I suppose what we try to do at Zurich is we try to look at the fundamentals of the markets rather than looking at what we call noise. What you hear on the radio, what people talk about at dinner parties. A lot of it's noise, and really what we try to do is look at the fundamentals. Now, sometimes you can get caught out, and sometimes some of this noise can actually hurt the markets, what you read in the papers and so on. But we try to stick to the fundamentals. Where is GDP going? Where is inflation going? Where are interest rates going? What is the valuation of different asset classes? They're the fundamentals, and we try to stick to those and avoid noise. And in the long run, that works out well for us at Zurich. So we've had lots of noise last year. Again, some of this can catch you out occasionally. There's lots of things happened last year. Markets were very volatile last year in 2016. We expect that volatility to increase, to remain in 2017. The year started off well for equities, badly for bonds. But that volatility is likely to increase. But last year we had lots of stuff. The oil price, you might remember, was very volatile, very weak at the start of the year, very strong for the rest of the year. Oil price went up 50% last year. Okay, very strong. Gold was strong. Commodities in general were strong. At the very start of the year with the China growth scares, you might remember that the first 6 weeks of last year, markets were down nearly 15% on the back of China. But again, the fundamentals came back in and the markets recovered. We had Brexit. The UK stock market's been the strongest stock market since the referendum result. Strange things happen in markets. You might have thought that UK equities would be hurt, but actually they've been the strongest stock market since Brexit. Why? Well, it's fundamental. It's due to the fact, in our opinion, that 70% of profits made from UK companies in the FTSE 100 are made outside the UK. The currency devalued post-Brexit, and that boosted UK's profits because 70% of their profits were made outside the country. You bring that back into the UK, and you've got roughly a 10-12% bounce in corporate profits. So Brexit turned out to be good for UK. If you're in the UK, obviously here in the Eurozone, we've been hurt by it because sterling obviously was hit. I've talked about Donald Trump. The main key thing here for the markets is corporation tax cuts. Is he allowed to do them? Will he do it? Certainly, so far in his first 30 days, he's done a lot of what he said he was going to do, or he's tried to do a lot of it. Not all of it popular, but I think the key is the corporation tax cut rates. And then we're looking into this year. We've got lots of elections coming up. Marine Le Pen in France. We've got elections in Holland, or the Netherlands, it should be called, Italy. There's lots of stuff that's going to take place during 2017 in Europe. So again, there's a lot of noise. We at Zurich try to distinguish between noise and fundamentals. Okay, and that's worked pretty well for us. Okay, just looking at some general points here. These are fundamentals of investing, and I suppose the key one is, what is your investment time horizon? So we've been talking quite a bit about pensions, which tend to be a long-term investment. Again, we're going to have a correction. We are currently having a big correction in government bonds. There will be a correction in equities. There's no doubt about it. There's going to be a 20-25% correction in equities at some point in the next few years. Okay? So if your investment time horizon is 1 year or 2 years, you should pretty much have all your money in cash. This is not advice now, this is just a fund manager speaking. We would have a lot of money in cash if you have a very short time horizon, because you don't want to walk into that 20-25% correction in equities. You don't want to walk into a 2008 type of scenario where markets were down 40%. So if your investment time horizon is short, be in cash. If your investment time horizon is medium to long term, you should have plenty of high risk, good returning assets in your portfolio, primarily equities and bonds, but equities always give a better return than, equities and property, apologies, but equities over time always give a better return than property. Equities are the best performing asset in the long run. So investment time horizon is important. The US stock market has never given a negative return over any rolling 12-year period. Okay, so in the history of the markets, if you'd stayed in for 12 years, you always would have made money in the equity market. Over 10 years, There's only been 2 rolling 10-year periods where you've lost a bit of money. It wasn't very much. That was the Great Depression around 1929, and not very long ago, the period up to 2009, the 10 years beforehand, you lost a small bit of money. But over 12 years, you never lose money in equities, and therefore, if your investment time horizon is significant, like in a pension, you should have plenty of money in equity markets. Risk is very important. All our funds and all our competitors, all the other providers in the market, all of our funds now are risk rated. Most people use the ESMA risk rating category of 1 to 7. So when I talk about a couple of our funds very briefly, you'll see there's a number after them, and that tells you the level of risk. 1 is very low risk, cash, not necessarily an Irish bank, but cash, generally speaking. 7 is very high risk, 100% equities. And all our funds are graded 1 to 7, and same for most of our competitors. Your personal risk is important. Owen talked about doing a risk assessment. That's very important to get that right, although you've got to be careful, because some people have going to a pension. If you're going to a pension for 40 years and you do a risk assessment and you turn out to be very low risk, you've got to make sure that your financial advisors do. They make sure that although you say you're a low risk person, they move you up the risk scale, because you should be in a higher risk area if you're in for a pension arrangement. And finally, asset allocation is key, and that is why actively managed multi-asset funds are the best way to invest your money, according to us at Zurich. It's asset allocation that makes you money. It's the key driver of returns. It's not whether you buy BP or Shell or Oracle or Microsoft. It's not those decisions that make you money. It's, are you in equities at the right time? Are you out of them at the right time? Same with bonds, same with property, same with cash and alternatives. That is the key, in our opinion, to investments. Currently at Zurich, we're overweight equities, underweight bonds. We've been moving our positions up in alternatives like commodities, which are performing very well. For example, we have copper in our portfolios. Copper is up 30% since the middle of October. Copper's on a great run. Commodity prices very often are driven by economic growth. Supply and demand is one, and then economic growth is the other factor which drives commodities. And currently, given that economic growth conditions are improving around the world, commodity prices are doing quite well. Okay, they're the 5 main asset classes, and I think the key for us and the big growth for us and our competition in Ireland is in multi-asset investing, moving in and out of these 5 asset classes. As I say, to us, equities look, again, they'll be volatile, but we still think they're going to give the best returns in 2017. Equities yielding 6.5%, or 3%, or 3.5% if you look at just the dividend yield. Bonds in Europe yield almost nothing, and they're falling rapidly. Bonds are down 8% in the last 4 months. Bonds are meant to be a safe investment, but they're down 8% in 4 months, a huge fall for bonds. And those falls could continue. So you should be very careful why you're in bonds at the moment. There's very little value in Eurozone government bonds, and you should question why you're in them at the moment. We're not. In our multi-asset funds, we're in very short-dated bonds. We're not in the medium to long area where most people are invested. Cash obviously yields 0. Property is still doing quite well. But as I say, over the long term, equities give a better return than property does. Okay, I'm going to mention just a couple of funds, just to sort of not to do too much marketing here. Some people may know our Super Cap fund, which has been around for 37 years, longer than my tenure in Zurich, and it's given a positive return in each and every one of those 37 years. Great fund, very safe, very secure. Doesn't give huge returns today relative to the past, but that's because interest rates are very low, and this is a bond, mainly bonds in this portfolio. And in case you may ask me the question, why do we have lots of bonds in this portfolio and we don't like bonds, the answer is we've got a sort of an insurance policy on the bonds in this fund, which means that if bond prices fall, we don't take the hit, a third party takes the hit, and that's currently the position at the moment. It's a risk-rated 2 fund. Here's a risk-rated 4 fund in the middle between 1 and 7. It's called the Active Asset Allocation Fund. It's been around for about 6 years, great performer. This is our most important fund, not the biggest fund, but it's the most important fund we have at Zurich. Because when we change the asset allocation in this fund, which we do regularly, the asset allocation in every one of our multi-asset funds, we have many multi-asset funds, managed funds, multi-asset funds. The decisions we make in this fund are replicated in all our other funds. So if you were to watch Zurich, and watch what we're doing. Keep an eye on this fund, because this fund will tell you what we're doing everywhere else. And when you look down at the bottom, if you can read the slide there, the bottom box there, it says the 5 main asset classes. And the top one, it says equities. And there's numbers there, the range is 15 to 65%. So if we like equities, if we really like equities, we'll be in the 60s, where we are at the moment, we're at 62. If we don't like equities, we'll be down towards 15, 20%. And that's what you get from Zurich. You're getting a manager who moves in and out of different assets, hopefully at the right time. We have a very good track record. We don't get it right all the time. I think a few years where we got it wrong, but most years we get it right, and our performance has been very good. We currently like equities, but I can assure you, and a correction will come most likely in the next couple of years. We will have the equity content hopefully down at the bottom of the range hopefully before, or certainly soon after the markets start to come off. That's what we do at Zurich. Okay, and again, very difficult probably to see this one, but just to show you that we do what we say we do. If you look at the bottom bar here on this chart, it's blue, chart maybe difficult to see. You can see back in the summer of last year, the equity content was 40%, which is kind of middle of the range of 15 to 65. And then in the late summer, early autumn, we increased it to over 60. So that's really done well for us, because markets are up very strongly in the second half of last year. Into this year, the US market's up 5% already this year. Other markets not quite as good. But that policy has worked very well for us. Again, if we feel there's going to be a correction in equities, which will happen undoubtedly, we'll hopefully get that equity content down, way down, towards the 15, 20, 20%. Okay, just moving on then. Okay, and that's just the balanced fund. This is our longest, not the longest, the 37-year Super Cap fund is our longest fund. This fund is 27 years old. It just happens to coincide with when I started at Zurich. There's no sort of correlation particularly, except I have been involved in managing this fund. Very dear to our hearts. It's gone up 10% per annum since inception. It's a pretty good return all the way through the last 27 years. Through the ups and downs of the markets, wars, scares, crashes, good times and bad times, and it's given a return of 10% per annum, which we're very proud of. It's the best performing multi-asset fund in the marketplace over 5, 10, 15, 20, 25, 27 years. It's been going for 27 years. And again, we move in and out of different assets, and we're trying to outperform. And there is the outperformance. The blue line is the balanced fund I've just been referring to, and the lighter blue line is the competition. And we've outperformed. You see the numbers on the very right-hand side. The big difference between the returns in cumulatively over that period, we have outperformed significantly. It is only outperformance of 1.5% per annum, so it's nothing spectacular now. I'm just trying to say that, but it's just consistent outperformance by 1.5% per annum. If you compound that over 27 years, you're getting this huge difference in the return from Zurich against the competition. So that's the end of the marketing. The really important thing about the slide is the lines keep going up. These are mainly equities. These managed funds would have 65, 77, depends on the fund, that kind of level of equities. The rest are in bonds and cash and alternatives. But that just shows you that the markets keep going up. But there are big corrections in the middle, and obviously there have been a number of corrections. The key one, of course, was the 07-08 crash, which is 2/3 the way across from left to right. And you can see the big declines there because equities fell over 50% during that 2-year period. So dreadful decline in equities. Some of these funds did come off, but look how fast they came back into positive territory. And where they are now relative to where they were even before the big crash in 2007. So the markets keep going up, and if you're active and you can get in and out of the right assets at the right time, I think you can do pretty well. Okay, briefly on bonds. I'm not going to go through much in this slide. This is the bond market over the last, international bond markets over the last 35 years. And the line is falling, okay? But that's good, because that's the yield, all right? So as the line falls from left to right, bond prices are going up. So we're a little bit strange in the investment world. We talk about the bonds, we always talk about the yield. We don't talk so much about the price. We probably should, but everyone talks about yield. So the yield is falling, the price goes up. And it's been great times. I mean, we've had falling inflation since the late 70s, thanks to China, thanks to Ryanair, and equilibrium level for German yields might be 3.5%, and they're probably going to head back to those kind of levels. But that will cause significant damage to bond prices as that happens. And already bond prices are off at the sort of median level of bond yields, median duration, by 8% in the last 4 months. Long bonds are off 10 to 12% in the last 4 months. So bonds are certainly struggling at the moment. We think the yields are going to go higher, and therefore in our multi-asset funds we're underweight government bonds. Watching the time here now, I've got about 5 or 10 minutes. Okay, what else could give you, or give us, or give investors a boost in equities? Equities have been going for 8 years. Most people don't like equities. Most people don't trust equities. Most people think it's a crash around the corner. And yes, there will be, not a crash, but there will be a correction at some point in the next few years, undoubtedly. But what could drive markets higher before that correction? And this is probably the chart that will provide that next leg up in equity markets, in our opinion. It's not advice, it's just our opinion. The blue line is flows of money into bond funds in the last 10 years. And the red line is flows of money, big international investors, into equities in the last 10 years. So you can see where the money's been going. It's been going into government bonds. It hasn't been particularly going into equities. And why has it been going into bonds? It's been going into bonds because governments have been, our central banks have been printing money and buying bonds. It's been just a party for government bonds. Why wouldn't you join in? If the central bank is going to keep buying the bonds, printing money and buying them, why not join in? And that's what international investors have been doing for the last 10 years. The problem is there's no value. There's a bit more value in the States. So the US yield has gone up from up to nearly 2.5% from 1%. So there's been a damage in the States. It's a bit more attractive in the States. But of course, quantitative easing ended in the States a year or so ago. But it's still ongoing in Europe and Japan. But the party's nearly over, and we think it's over. And we think that monies are now going to reverse. We've already done it, but we're only a small fish in a large pond. But we've taken a lot of money out of bonds and put them into equities in the last year. And we think international investors are going to now do the same. It's already happening. The blue line is going to fall and the red line is going to rise. People are going to put money back into equities. And as that happens, clearly, equity markets could go higher. That's the bull market in equities in the last 8 years. I hope you've joined in. Unfortunately, not many of our clients, but the biggest redemptions we've had in the history of Zurich, and they weren't huge, but the biggest level of redemptions were in March 2009, okay, which is the very bottom of the chart here on the left-hand side. And unfortunately, people panicked, and it's understandable. The falls were so great in 07, 08. In early 09, people panicked, and some people did, and they got out of equities. And they stayed in cash for many years. And now, of course, they're looking at this chart and saying, well, can I get back into equities? Is it too late? Is there a crash coming? And this is the big dilemma for investors. Fortunately, most of our investors didn't panic, particularly those who were in pension schemes, which were sort of lifestyling pension schemes where the money just kept flowing in and people did very well. But it is a dilemma for people who got out of the markets at the bottom, who missed the up leg. It is certainly a tough decision now to go back in looking at that chart. We think there's more to go. It will be volatile, but certainly for the next, this year, certainly we think equities are still the place to be, not government bonds. Now, the potential Achilles heel for equities, and what you'll hear most people talk about, most commentators talk about, is that the markets themselves, the equity markets themselves are very expensive. And this is the chart which will be used as evidence to support that argument. And I don't disagree with it. I mean, equities are cheaper than other assets because they yield more. They're much cheaper than bonds. They're much cheaper than cash. They're cheaper than or cheaper is a bad word, they're better value than bonds, cash, property, and alternatives. But when you look at equities in isolation, they're not particularly cheap. And what we do in the markets, I'm sure you all know this, we look at the price earnings multiple. It's the key tool we use in investments. And if we look down there, the global PE for this year, that's 2017, it says 16.3. That's 16.3 times earnings is the value of the market. The rough rule of thumb is that the PE goes from 10 to 20. 10 is considered very, very good value. Back in March 2009, the global PE was 8 times. We've never seen it so cheap, that's why we bought it at that point. Now it's 16, and if it got to 20, alarm bells would have to be, ringing. So it's not 15 is equilibrium. Now it's got higher than 20 in the past. I mean, in the dot-com bubble in 2000, which was crazy stuff, it got to 35 times in America. But generally speaking, when it gets to 20, that's usually a time to be thinking about maybe taking some equities off the table. But we're not there yet. America is always more expensive than the rest of the world. It's on 18 times. But if the US administration reduces corporation tax cuts by 10-15%, we'll get a 10-15% balance in profits, which would knock this number back to the global one from 16 back to about 15 times. So we're not overly concerned about it. It's not excessive. If it was 20, if the global PE was 20, we would be concerned. It's currently 16. It may drop a bit if the corporation tax cuts come in. But again, this is the one that people will tell you about if equities, if you're negative on equities. Finally, it's coming up now to 9 o'clock. 2 more slides, maybe this is the last one. This is a bit of fun in a way, but it's also serious. Now, the red line is the US stock market. Even though it's been despised and hated and not trusted, it keeps going up. The blue line is the sentiment index that we look at. Okay, are people bullish or bearish? If the blue line is over 50, people are very positive about equities. If the blue line is under 50, which is on the right-hand scale there, if it's under 50, people are negative about equities. Okay, and by and large, throughout this bull market, people have been negative about equities. It's hard to sort of fathom it, but people haven't trusted equities, but they keep going up because obviously someone's buying them and someone's paying more for them. But people don't like when they're asked what they think about equities, they don't like them. And we at Zurich use this as a contrarian indicator. Now, we're fundamental investors, but we do look at a couple of these sentiment indicators. And at the moment, if this line if the blue line is low, we tend to buy, and if the blue line is high, we tend to sell. It's not a fundamental reason, but it's a backup reason. In other words, if people like something, we tend to sell it, and if people hate something, we tend to buy it, and it usually works. Think of property back in the Celtic Tiger. Everyone loved it, and everyone was buying. People were queuing up to buy property. That's the time to sell it. And when everyone hates something, it's often the time to buy it. When there's blood on the streets, as they say, you should buy property.